BP shares are receiving renewed analyst attention this week. The reason looks straightforward at first. Middle East tensions are pushing oil prices higher. Higher oil prices are historically a direct tailwind for BP's earnings. So the bull case writes itself: geopolitical premium, commodity uplift, re-rate. Except that is not what is happening. BP is simultaneously running one of the most significant restructuring programs in its recent history. That restructuring is creating uncertainty around medium-term targets, and uncertainty around targets suppresses the multiple investors are willing to pay, even when the commodity environment turns supportive. So BP is carrying two opposing forces at exactly the same time: an external tailwind pushing the earnings line upward, an internal execution risk pulling the valuation multiple downward. The market has not yet resolved which force dominates. That is the contradiction at the center of this analysis. And it is not a contradiction that resolves itself passively. A holder of BP today must decide whether the geopolitical tailwind is durable enough to justify re-rating before the restructuring delivers clarity. That is an active judgment call, not a hold-and-wait situation. The proactive article this week describes the trading environment as highly supportive. That phrase is doing a great deal of work. It implies that conditions favor BP right now, but supportive trading environments do not automatically translate into sustained re-ratings when fundamental uncertainty remains on the table. The distinction matters enormously for how a holder sizes their position today. BP shares are up around 25% year-to-date, with Brent crude hovering around $90 per barrel. The year-to-date performance looks strong in isolation, but it has been accompanied by increased volatility, precisely because the two opposing forces have been pulling at the stock in alternating directions. That volatility is the market pricing its own confusion, and confused markets are where positioning errors compound. The geopolitical origin of this week's oil price move is specific, not abstract. The Iran conflict is functioning as an energy shock with a direct transmission path into crude supply risk. It is worth being precise about how that transmission reaches BP's reported numbers. Iran is a significant crude producer. Conflict that disrupts supply or raises the perceived risk of supply disruption pushes the spot price of crude upward. Brent hovering around 90 reflects that risk premium being priced into the market. BP, as an integrated major, benefits on its upstream production division when crude prices rise. Every barrel BP lifts from its own reserves is worth more at the wellhead. The upstream segment is the first and most direct transmission point. But here is what most coverage of BP's geopolitical tailwind underweights. BP's integrated structure means the downstream refining margin is simultaneously affected, and not always in the same direction. When crude rises faster than refined product prices, refining margins compress. BP's downstream operations can therefore act as a partial offset to the upstream gain. The net benefit to BP's total earnings from an oil price rise depends on the speed and magnitude of the move, and on whether downstream product prices follow. A rapid, conflict-driven crude spike, the kind produced by geopolitical shock rather than demand growth, tends to compress margins at the refinery level before product prices catch up. This is the part of the transmission path that the highly supportive trading environment framing does not capture. The tailwind is real, but it is not clean. Its net impact on BP's earnings is mediated by refining dynamics that are less favorable in a shock-driven price environment than in a demand-driven one. There is a second layer to this. Middle East tensions also raise the risk of broader economic slowdown if energy costs remain elevated. Demand-side headwinds, if they emerge, can offset the upstream price benefit within a matter of quarters. So the geopolitical contribution to BP's earnings is simultaneously the strongest argument for re-rating and the most conditional one. It depends on duration, on product price catch-up, and on whether higher costs slow global demand before BP's next reporting cycle.
RBC's note this week did not simply say BP would benefit from higher oil prices. It said BP needs to show clarity and deliver on medium-term targets amid boardroom drama. That framing is worth unpacking carefully. The phrase boardroom drama signals that internal leadership dynamics at BP are not yet resolved. Boardroom instability creates a specific type of investor risk that is separate from commodity exposure. It introduces uncertainty about strategic continuity, whether the current restructuring plan will be executed as stated, or whether leadership changes could alter the program's scope, pace, or direction. RBC's language implies that this uncertainty is currently visible enough to require explicit acknowledgement in analyst commentary. That is a meaningful signal. When a major bank's analyst feels compelled to name boardroom dynamics in a note about a commodity tailwind, it suggests that the internal uncertainty is offsetting the external benefit in investor minds. The medium-term targets themselves are the second element of RBC's concern. BP's restructuring involves commitments around cost reduction, portfolio simplification, and capital allocation. Investors are being asked to price in the delivery of those commitments, but delivery timelines have not been confirmed in a way that removes doubt. RBC's call for clarity is effectively a statement that the market is discounting BP's targets, not because the targets are wrong, but because the execution path is not yet visible enough to underwrite. Here is the thing that is easy to miss in this framing. The geopolitical tailwind, if sustained, could generate earnings that temporarily exceed the level implied by BP's own medium-term targets. That would create a paradoxical situation. BP beats its own targets not through operational delivery, but through commodity luck. A beat driven by oil prices rather than restructuring execution would not reduce the strategic uncertainty that RBC is flagging. It would mask it, potentially for several quarters. Holders who re-rate BP on commodity momentum alone may find themselves holding a position whose underlying execution risk has not actually diminished. The market's hidden assumption here is that a commodity tailwind and a restructuring program can be evaluated independently. That assumption is the one that breaks down. In practice, a commodity beat can delay the pressure on management to deliver restructuring clarity, and that delay can extend the period of strategic uncertainty.
The forward checkpoint for BP holders is not a single date. It is a sequence of conditions, each of which partially resolves the contradiction identified in Chapter 1. The first condition is whether the Middle East oil price move proves durable or mean reverts. Conflict-driven crude spikes have historically been volatile, sharp on the upside but prone to giving back gains once supply disruption fears ease. If crude pulls back before BP's next reporting period, the tailwind narrative dissolves. The second condition is whether BP's restructuring program delivers a visible milestone. RBC's note names medium-term target delivery as the key credibility moment. Until BP produces a concrete operational update that confirms the restructuring is on track, the execution discount remains in the stock. The third condition, and the one most likely to be underweighted, is boardroom resolution. Leadership uncertainty does not resolve through earnings beats. It resolves through visible stability, a confirmed leadership structure, aligned strategic messaging, and a period of execution without public internal conflict. That process typically takes longer than a single quarter. So the honest position for a holder today is this. The trading environment is supportive in a way that may flatter near-term returns, but the structural uncertainty, execution risk on restructuring targets, unresolved leadership dynamics, and the ambiguous net benefit of a shock-driven oil price has not been addressed by this week's tailwind. The question is not whether BP benefits from higher crude, it does. The question is whether a holder is being paid enough for the uncertainty that sits beneath the commodity uplift. That judgment sits at the intersection of timing, conviction, and tolerance for unresolved internal risk. This week's news moved one variable on that checklist. It did not move the others. The ones it did not move are the ones that will determine whether the re-rating holds. Brent at $90 is the number to watch. A sustained hold above that level extends the earnings uplift window. A drop back toward $80 reopens the question that the commodity move temporarily closed. That is the checkoff anchor from Chapter 1. The same $90 figure that created the highly supportive environment framing is also the threshold that defines whether this week's bull case has a foundation. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.